Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and this is a special evergreen podcast, sort of evergreen. We're talking about recessions, and evergreen in that we're not going to actually talk at length about any of the statistics that have come out, economic statistics, but just about recessions, the history of recessions, causes, leading indicators, what goes to the severity of recessions, policy responses. And then ultimately, we'll bring it all back to the current situation in the high probabilities of recession and talk a little bit about that. Joining me in this discussion are my two co-hosts, Ryan Sweet. Ryan is the director of real-time economics, and Cris Dorides, deputy chief economist. And we're all here in suburban Philly, waiting for a storm. Ryan was telling me that your kids got out of school early because of the storm?
Yeah, it was supposed to be a pretty bad storm, but I have empathy for weather forecasters.
Yeah.
We all should, being economists. So, if we don't get a storm, I'm not going to blame them.
Well, I mean, there is a front going through, so there's thunderstorms. It's just, I guess the question is where are those going to actually hit, right? So
right.
That's a bit.
I'm looking out the window and it looks pretty nice outside right now.
Oh, is it your place? It looks like it's a little drizzling here, but certainly nothing to be all that worried about. But well, I guess we'll see how it goes. And Cris,
I thought you were getting metaphorical on us there.
How so?
We're waiting for a storm, right?
Talking
about recessions.
Yeah, that would have worked.
Yeah.
Could have definitely gone down that path for sure. And I had all kinds of, comparisons, economists, weathermen, but I thought that's pretty hackneyed,
Yeah.
Yeah.
We exist to make them look good, right? That's
the standard.
That's the
joke.
Classic.
Yeah. Any other good jokes? Economist jokes? Actually, here it's very funny. I was going to give. I can't remember for what. I had to give a speech, and they wanted me to talk a little bit about economics, and I said, okay, I'll tell a joke, an economist joke. They're not easy to find. I Googled economist jokes. We're a pretty boring bunch, I think.
We are extremely boring.
Yeah, there's no such thing as a good economist joke. There was one. I can't remember what it was. So it couldn't have been that good because I can't even remember it. But I spent like an hour looking for an economist joke and I just gave up. I couldn't find one.
The only one I heard recently was, what's the difference between an accountant and an economist?
What?
I mean, an economist is an accountant with a sense of humor.
Oh, there you go.
I was like, all right, that's about it. The well is dry now.
Yeah, right. Very good. And I should say, in this discussion, we are going to play a game, although it's not going to be the statistics game. Well, I guess it is a statistics game, but it's going to be around recession statistics, not a real-time economic statistic. Okay, recessions. Okay, how do we define recessions? You want to take a crack at that, Ryan? How do you define a recession?
Okay, so I'll give you the NBER's definition. Now I'm paraphrasing, but essentially,
for the folks National out there, Bureau, NBER.
Yeah, the National Bureau of Economic Research. So essentially, a bunch of economists get in a room and they define where we are in the business cycle, and they define a recession as a significant decline in economic activity that is broad-based and lasts for more than a few months.
I never heard that last bit. More than a few months.
Yeah, I think you're tacking that on.
I am not.
Is that your own? You added that.
All right, hold on.
Well, hold it, because the pandemic recession was 2 months. Is that not a recession?
That's Scott Hoyt, one of our colleagues. Him and I had this debate. It was like, if it's just a few months, can it be really a recession? But it was so significant that they had to call it a recession.
Well, it was a recession.
Well, I know, but
yeah.
All right, here you go. On the NBER's website.
Okay.
All right. What is a recession? The traditional definition of a recession is a significant decline in economic activity that is spread across the economy and that lasts for more than a few months.
Oh, that is news to me. I did not know that. I think they must have added that since the last time I looked 25 years ago.
Yeah. So that definition is different than what we learned in principles of macroeconomics.
That's actually they didn't actually, they violated that definition then, right?
I would assume so.
All right. I mean, I would just say, paraphrasing that, this is how I describe it: a broad-based, persistent decline in economic activity. That's a recession. right?
That's the NBER's definition without a few months.
Yeah, that's right. No, but mine's much clearer.
Yeah.
Uses less words, which is always a good thing. Very clear. Okay.
I would say it's just a general decline in output or activity.
You wouldn't say broad-based?
Yeah, general. That's broad-based.
Yeah.
Keep it short and sweet.
As opposed to broad-based, you'd use the word general, you're saying?
Yeah, general.
Okay. All right, general. I like broad-based, but okay, general.
All right.
Okay, so but that blows out of the water kind of the standard way people, like if you talk to most people, they say a recession is 2 consecutive quarters of negative GDP, right?
Correct. That's what we learned in Principles of Macroeconomics.
You learned that? Well, geez. Where'd you go to school, buddy?
Washington.
No, don't answer that question.
I teach at Westchester in the textbook that we use. It says,
no, really?
No.
Yes. I will bring the textbook in and show you.
Oh,
I don't even want to know.
That's why when I teach it, I was like, I ignore that definition because that's, at least in the US, it's not what a recession is.
And
all
actually,
right, we're gonna have to write our own book.
And I think the 2001 recession that came after the blowing up of the Y2K equity bubble, that wasn't 2 quarters of negative GDP, right?
No. GDP barely fell. Yeah.
Right. They were like alternating.
Yeah. Well, I don't even think that would have been labeled a recession if not for 9/11.
Correct. Yeah.
Right? Because it declined 1 quarter, we seemed to be coming back out of the doldrums. And then obviously 9/11 was devastating.
Mm-hmm.
It took us right back in. Yeah.
Yeah.
Okay. Take right now, in current situation, we saw a negative GDP number and GDP for everyone is gross domestic product, the value of all the things that we produce. That fell in the first quarter of this year. And it's actually, right now, your GDP tracking, correct me if I'm wrong, Ryan, is pretty soft for Q2, right?
Yeah, given the decline that we got, it's only projecting 2.2% increase in the second quarter.
Okay, but it's conceivable that actually goes negative too, right?
Oh, yeah.
Trade. So let me ask you this.
Yeah.
Suppose we had 2 quarters of Q1 decline, and let's just say, for whatever reason, trade or inventories or whatever, say that another wave of the virus comes back and so forth and so on. We have a negative quarter in Q2. Would you consider this a recession?
No.
And unemployment remains low.
Well, everything,
everything else is fine. Right?
Yeah, everything else is fine. Like it is now. In the Q1, we saw negative GDP, but everything else was fine. Jobs, unemployment.
It doesn't fit the definition. It's not broad-based. Because the decline in GDP is inventories and trade.
Right.
Everything else is fine.
That makes sense. Right.
Okay.
Mm-hmm.
So I think I like broad-based to describe that, not general. Oh, I guess general's okay. All right.
The general theory of relativity, they don't call it the broad-based theory of.
The general theory of relativity. Yeah, that's a good point. That's a great point. All right. Well, maybe I'll adopt that. So in other countries in the rest of the world, and that's the weird thing. One other weird thing about defining recessions, it's not the federal government or a government that says, hey, you're in recession, hey, you're out of recession. It's a group of academic economists that are at the National Bureau of Economic Research that form this business cycle dating committee. We know a lot of them, like Jim Stock and I think Christy Romer, I'm not sure, or Bob Gordon, these guys who follow the business cycle very carefully, all absolutely fabulous academic economists. And I didn't mean it that way. They're absolutely fabulous economists, but they're, I guess academic because unbiased. There's no bias. There's no political, influence on these folks when they make a decision. Is that, how do they do it overseas? You guys know? I know, I'm sure it varies country to country, but like what do the British do? Do you guys know? Or the Canadians or Germans or Japanese?
Japanese use, they call it a technical recession, which is 2 consecutive quarters of declining GDP. I think many countries use that.
I thought that was the same for the UK as well.
Mm-hmm.
Well, that's an interesting distinction. So you could say if I have 2 quarters of negative GDP, it doesn't have to be a recession. You could label it a technical recession.
Yep.
Because everything else feels like it's okay. You're creating jobs, unemployment's low and falling. industrial production, incomes are all rising, but you still got those two negative quarters of GDP, technical recession.
Correct.
Okay.
And the NBR looks at more than just GDP. They look at employment, personal income, consumer spending, just a broad-based number of indicators. And that's why usually we're in recession before they actually date it as a recession.
Yeah, that's another interesting thing. It takes a long time for the committee to feel comfortable and confident enough to say, oh, the recession began March of 2020, it ended April of 2020. Actually, it was a little fat. They did it actually pretty quickly in the pandemic because it was such a V-shaped kind of situation. The economy cratered and then came back when everything was reopened. But in most recessions, it takes a while, a long time.
Yeah.
For this committee to say they're not about being fast, they're about being right.
That's right.
Yeah,
that's right.
And that's why economists are constantly debating, bickering. Are we in recession? Are we not in recession? And the recession could be over, at that point, but we're still debating it.
Mm-hmm.
Okay.
Yeah, they're the historians, right? That's the purpose of that dating committee. It's not for day-to-day business use, right?
But overseas, do governments define recessions? Do you know? I'm sure it's country by country, but
I think in some countries they do. I thought in the UK it was actually, well, if they're using a technical definition, right? I guess it's the government who's producing the statistic, and everyone knows that that's a technical recession. I know the IMF does some recession dating as well for globally. I think they use a few more measures, right? So it's also this general or broad-based decline in activity, but I think they consider a broader number of measures than what the NBER does.
Yeah,
but generally the same concept.
Okay, so I know the Business Cycle Dating Committee has identified recessions back to 1854. You want to guess how many recessions have occurred since 1854? Do you guys
in the U.S.?
This is all U.S. now, United States. Yeah. Okay, this could be my statistic. No, it's not a really good statistic, is it? Because
that's a good
one. A good statistic. Okay.
Yeah.
Okay. All right, and I'll ask you a follow up if you get close on this one.
I think there's been 14 since World War II.
No, I don't think so.
No.
12.
12 recessions?
Sure. I'm pretty sure.
Since 18?
No. Since World War II.
Oh, okay, 12. Oh.
Yeah. 12, right. 12 since World War II. And obviously there's been fewer recessions post-World War II than pre-World War I, because the economy's gotten more stable.
Well, I bet there was a lot more recessions before World War I.
Yeah, for sure.
Yeah.
1800s were full of recessions. Right?
Before the
Fed, the economy is much more volatile. Yeah.
Yeah.
I mean, the Fed was put on the planet in 1913, and with the goal of providing some stability to the business cycle, and they've been quite successful. If you go pre-1913, there was all kinds of recessions all the time. Panics and financial panics, all kinds of things. So, you want to take a crack at it? Just how many recessions since 1854?
20.
20. That's good, but that can't possibly be right if there was 12 since World War II.
Right. I'm going to go.
That's a bad. That I would label that as a bad
I'm assuming
guess.
that they were long recessions. Right?
Oh, okay.
Depressions.
All right.
I'm going to go 33.
That is okay, Ryan. Very good. 34.
34.
If I counted right, I could have counted wrong.
It could be 33.
It could be 33, but I think it's 34. I actually think it's 34. Going through the pandemic recession, which is the shortest recession.
Pandemic.
Yeah,
Pandemic.
right. 2 months. 2 months. Guess what was what do you think the longest recession was?
Are you grouping the Depression into it?
Yeah, Great Depression.
Mm-hmm. Oh, that's another great question. After you answer my question, then I'm going to ask you the question: well, what's a depression versus a recession?
Mm-hmm. So I'm going to say
I'm taking some of my cherry drink here. You guys tried cherry drink ever before? Highly recommend it. I do it for medicinal purposes, but it's very good. I haven't tried it with alcohol though.
Is it I was going to ask, is that a fermented cherry?
I don't know. What I'm sure I've never heard of a cocktail with cherry drink. Have you?
Yeah, isn't it a Manhattan includes?
Oh, that includes cherry drink?
I don't know if it includes cherry drink. It includes a cherry.
Okay. All right. Fair enough. I got it.
I don't know.
Okay. Yeah. Oh, now I forgot my question. Oh, this should be a slam dunk. Easy.
The longest recession?
Yeah.
It's the Great Depression.
Great Depression. Right. Right. That was like 1929 to 1933. That was like, I don't know, three years or something, something like that. 4 years. Right.
Wasn't that basically two recessions just really close to one another?
I think the NBER actually, I actually have it in front of me. Look, I think the NBER actually labeled it as one recession. So here,
okay.
August of 1929. When was the stock market crash? When was that in 1929? Was that was
October?
October. So it came a little after.
Seems like really bad things happened in the stock market in October.
Oh yeah, I think so. Through March of 1933. So that's a pretty long time, 43 months. So, a fair amount of time. Okay, so what's the difference between a recession and a depression? What qualifies as a depression? I mean, I've got my own homemade definition.
Well, everyone's got a homemade. There's no textbook definition of a depression.
Oh, like the NBR doesn't say anywhere, this is what a depression is.
I always think of depression, it has to have the 3 Ds. There's got to be deep. You have to have deflation, and then it has to be duration. So it could be a long recession.
Or how about disinflation as opposed to deflation? Deflation, that's a high bar.
Yeah.
Actually, that's a great definition. I hadn't thought of that, the 3 Ds. I mean, my sort of rule of thumb was if the unemployment rate goes above 10% into double digits in a consistent way, that would be a depression, particularly in the current context, the modern context. Because in the typical garden variety recession, unemployment goes to 6-7%, somewhere in there. So if you're above 10, that's depression. If you stay there, not in the pandemic, we went to 15, I believe, right, for a month, and then we came right back in. So that doesn't qualify. But if you're double digits for 6, 9, 12 months, that's a depression, in my view. Yeah, but I don't think by that definition in the modern era, I don't think we've even in the 80 recession, we got into double digits, but not long enough, I think, to qualify. Right. Okay. Anything else on how to define a recession or depression before we move on to the causes? I will say something I said earlier, just to reiterate, and we'll come back to it. Big difference in the length of business cycles, the duration of recessions, pre-Fed, post-Fed. If you go back and you take a look at that data from the NBER on recession dates, back in the late 1800s all the way up until, the Great Depression, very clearly the economy was much more cyclical. Expansions were shorter, recessions longer, business cycles were much quicker. Since World War II, and given what the Fed has done since World War II, much longer business cycles, longer expansions, very, very short, much shorter recessions. I think the recessions now typically last, 6, 9, maybe 12 months, somewhere in there, no more than that. Okay. All right, let's talk about causes of recession. So what, there's a whole range of kind of necessary, and then maybe necessary and sufficient conditions for recession. So let's go through each of those. So, Cris, what would you put at the top of the list for causes of recession?
Classically, it's kind of inventory boom bust cycle, right?
So you'd say imbalances. There's got to be an imbalance in the
correct.
economy. And you're saying inventories historically, when we were a manufacturing-based economy, that was a major imbalance.
Correct.
Okay. Less so now, though, right?
Yes, less so. Yes. But certainly.
Okay. What other imbalances generally, typically might be? And when I say imbalance, what I mean is there's something kind of off in terms of the economy's balance sheet, in terms of the leverage, high leverage, or on the asset side, speculation bubbles, something that's just very atypical. Or in the financial system, the banking system's undercapitalized, or there's a lot of poor underwriting. Those are the kinds of things I think of as being imbalances. Is that how you think about it?
Yeah, I do. So asset bubbles, certainly one cause of recession. That's more modern. Mm-hmm. If we go back to the housing boom, bust period.
Yeah. I would make a distinction between leverage and asset values. It feels like to me, leverage kills. I mean, if you got a lot of debt, that is a much bigger macroeconomic problem than, high asset prices, even a bubble that bursts, because that's equity. That's not debt. It doesn't, drive companies out of business per se, or cause households to default, go into foreclosure, bankruptcy, that kind of thing.
True. Although if we're talking about recessions, the two usually go hand in hand, right? You had a lot of house prices went up, and you had a lot of mortgage debt.
Well, that's the worst.
Time, right? So that's that's the combo that brings you into recession or causes a deep recession. Right?
Yeah. Well, I guess there's two case studies, like with regard to asset bubbles. I mean, you go to Y2K, that was a whopper of it. Felt like an equity market bubble. The internet was coming on, pets.com, that kind of thing. There was some leverage, but it was not a lot of leverage. There was some margin debt, but that really wasn't the issue, right? It was, people started behaving based on the fact that they thought they were a lot wealthier given the run up in stock prices. And when stock prices went down, then they pulled back, the negative wealth effects. But that was a very minor, modest kind of economic downturn. And as we said earlier, may not even have become a recession if not for 9/11 hitting at that time. But if you go to the financial crisis, the recession hit in 2008 or first half of 2009, we had an asset bubble in the housing market, and that was leverage induced. I mean, a lot of mortgage borrowing, egregious mortgage lending, weird mortgage products that juiced up demand and helped to create this bubble in the housing market. So it feels like a different kind of problem. Does that resonate?
Yeah.
Mm-hmm.
Yeah, I'd agree with that.
Any other kinds of imbalances? So first condition for recession is these imbalances. It's kind of fault lines in the economy's balance sheet. What about overbuilt real estate markets? That's another, I would think, reasonable one, right?
Yeah, it's another imbalance.
Yeah.
Yeah.
How about what I would call spent up demand? So, during the boom times and the expansion, people spend a lot of money. They spend beyond what they would typically. Their saving rate goes down. They buy, a car a year before they would normally buy a car. They buy furniture before they would normally buy the furniture. And so you have this kind of situation where people have bought forward what I call spent up demand as the, opposite of pent up demand that develops during a recession and helps power an expansion.
Mm-hmm.
I would consider that. Would you consider that an imbalance as well?
Yeah, certainly.
Yeah.
And it could come from a variety. It could be inflation driven, right? If inflation is going through the roof.
I would characterize, I put that
right?
into a different
My
bucket.
behavior might front load some of the spending.
Yeah, true. I would say though that the imbalances are kind of separate from the kind of the business cycle overheating dynamics, which is I consider to be a second kind of condition for recession. But before we go there, think about the current environment and all the recession fears. You said the most important precondition for recession is an imbalance in the economy, right? And we identified a few of them. You mentioned inventory, leverage, asset bubbles, spent up demand. So what exists in the current environment that is an imbalance that would result in recession?
That wouldn't.
Ryan?
Well,
I'm going to Ryan because Ryan
Okay.
thinks there is going to be a recession. So what is it? What do you think that is?
Well, you think that there's asset markets, like the stock market was overvalued.
Yeah, but
You've seen
it
that come
wasn't
down.
speculative, right? It wasn't.
If you look at leverage, a lot of margin, a lot of
really?
margin debt.
How much is the margin debt? 400 billion, right?
Yeah, I got to look at it as a share of.
Yeah. Nothing.
But you have a lot of spent up demand on goods. The only place that could save us is that there's pent up demand for services.
Yeah.
So a little bit of offset there.
Cris, you're also thinking recession. Not as high a probability as Ryan.
Sure.
So where's the imbalance? What imbalance are you pointing to?
Well, a recession isn't just caused by imbalances, right?
Okay, so you're saying it's not a necessary condition for a recession.
No.
It's a potential condition for a recession.
Correct.
I mean, look at the pandemic. That was a shock. That wasn't an imbalance. So
that's kind of a case of its own, though, right? I mean,
right.
Yeah, that doesn't feel like it fits into. It's not a case study for future recessions. Unless
what about the energy price shock of the
supply shocks? Certainly create recessions.
I say that's a separate category. That's a separate set of factors. When you say, hey, what are the causes of recession?
Yeah.
First set of things are, and you brought it up first, is the imbalances that exist in the economy. And we can identify imbalances that exist in the economy prior to almost every recession, at least ex post, ex ante, before the fact. That's harder to do, and that may be the case today. There may be problems out there that we're not appreciating, or at least Mark Zandi's not appreciating to the degree that we should. But that's one set of factors that are that's behind recession. Mm-hmm. Second set of factors is, you mentioned it, but in that case, you're hard pressed to come up with a smoking gun kind of imbalance. Is that fair to say?
Yeah.
Which doesn't mean there won't be a recession. I'm just saying.
Right.
Yeah.
Okay.
And that could go to the severity of the recession.
Yes,
you could say, okay, I'm going to have a recession, but it's going to be less severe because I don't have a problem, and there's not significant imbalances. But I'm probing you because I want to know, is there something out there, some imbalance in the economy that you think is potentially a real problem that people have not been focused on or identified?
I would say potentially a problem, but probably not going to be the cause of recession. Would be some corporate lending, right? Some of the leverage lending, some of the zombie companies that we were worried about before the pandemic. They kind of got a lifeline with low rates. As rates go up, I am worried that you're going to see a lot more defaults, but I don't see that as being the real trigger of a recession. It might make it harder to come out of recession, right? Extend the recovery period, but
yeah, I mean, I think in every case, these imbalances by themselves don't cause recessions generally.
Right.
You have some kind of shock. Something goes off the rails, then the economy is stressed, or it could be interest rates are rising because of an overheating economy. Economy is stressed, and you have these fault lines that exist in the balance sheet that get exposed by the stresses that are coming on the economy through the shock or through the higher interest rate environment. Mm-hmm. So right now we're focused on the fault lines in the economy, and you're saying, okay,
some corporate debt.
Yeah, Ryan mentioned equity prices. That feels like a stretch, but okay. You didn't mention house prices. Do you think that's a fault line? Because they're very high, as we've documented, are overvalued. Do you view that as a fault line?
It's a risk, but as we've discussed, there's a lot of demographic, other factors out there that seem to offset it. But things can happen, right?
Going to the point that the fault line could be deeper than we know. Particularly you get stressed. But now you're saying, okay. Also, the other place I would look is in the corporate leverage, corporate debt, corporate balance sheets, that there's this group of companies that are out there that, if you look at the corporate balance sheet altogether, it looks okay, right?
Yeah, sure.
But you're saying that the debt is kind of barbelled. You got on one side of the distribution a bunch of companies that are in fine financial shape. Take Moody's or take Apple, got a lot of cash, right?
Yeah.
If they got any debt at all, it's because it's essentially up until now free money.
Opportunistic,
why wouldn't you do it? And then on the other side of the distribution, you got these companies that are all levered up that have kind of highly kind of PE firms have come in, levered them up, looking for higher equity returns. They've kind of levered up right up to certain rating thresholds, which might affect if they get lowered. If their ratings are lowered, they might lose access to markets, and their cost of capital will go up. And that's where you're saying we should be looking. That might be a stress line. Okay.
That's right. They're facing higher rates, so higher financing costs on top of higher wages, on top of higher energy costs, right? There's a lot of negatives that if the demand side should fall as well, right, that could certainly lead to more defaults.
Okay. Okay. I agree with you. I think that is a potential fault line that we need to focus on. Do you have any numbers on that, or I'm pressing too hard? I mean,
I don't. In the past, I've looked at it. It certainly was small,
okay.
much smaller than what we saw in the housing bust, right? So I don't think it's, even if there is a problem there, I don't think it's to the magnitude of the Great Recession, but certainly could create some issues.
Okay. All right. Okay. That's one set of causes that they're not imbalances in the economy, that what we're calling imbalances, and they don't necessarily, they're not a necessary condition for recession. You can have recession without imbalances.
Yes.
Okay. All right. Okay. Second set of causes, or second bucket of causes, you alluded to it, was the potential of an economy that's overheating, right? Would you characterize it that way?
Yes. Yeah.
You would. Okay. So do you want to describe that? What that risk is, or why is that a cause of recession?
I think you already did, right? In terms of the inventory side, you have an economy that is firing on all cylinders. It's going too far. There's a euphoria out there. People are spending, pulling ahead some of the spending they might otherwise do, and at some point it runs out of gas, right? You've gone too far, and therefore there's nothing left to buy, or I guess we'll go to a bigger point, which I'll assert that all recessions at their heart are sociological phenomena in terms of when they actually begin and end. But that there's this general thinking that, or this belief that the economy is going down, and that becomes a self-reinforcing cycle. But
right,
sort of sounds like today.
You think so?
Yeah, I mean, you're seeing measures of consumer confidence dropping. We know it's gas prices, stock prices, stuff like that, but small business confidence they're pretty pessimistic.
Yeah, it's not caving though.
But the spending isn't really.
And the spending hasn't
taking
budged,
a hit, right?
I mean, it's still strong.
Mm-hmm.
People are worried, right? They're saying they're worried, but their actions so far are not in panic mode.
The way I would think about this cause of an overheating economy, and this is kind of typical in business cycles, right? The economy expands for an extended period of time, unemployment declines. At some point, unemployment gets low enough that it's consistent with full employment, and at that point, the economy's growth rate has to slow so that you don't blow past full employment. That unemployment rates don't go so low that you don't get these broad-based wage and price pressures that ultimately elicit interest rate increases and Fed tightening. And so, almost by definition, you're going to get, every business cycle is going to get to that place. Sometimes it's in an expansion that's growing more slowly. That takes a while. That was the expansion that was after the financial crisis for various reasons. Or the economy grows so strongly very quickly, you get right up to that full employment line, very, very quickly. And the business cycle is a lot shorter. But the cause of the recession is that you're going past full employment. Inflation becomes, wage and price pressures intensify. Inflation becomes more of an issue, and interest rates rise. And as those interest rates rise, they put pressure on the economy. They bring down asset prices like housing values and stock prices. They raise the cost of capital for businesses. They raise debt service for anyone who's borrowed money up to that point. It puts pressure on the financial system and their ability of banks to extend credit. So it's the increase in interest rates, and the faster that increase and the higher the interest rates go in a short period of time, the more damage that does. The more difficult it is for the rest of the economy to adjust to that, and the more likely you go into recession. And
after hearing that, I feel even more confident in my probability of recession.
I mean, in my view,
describes us today.
Yeah, in my view, that is well, let me say it this way. I think that is also not a it's almost a necessary condition for recession. Almost necessary. It doesn't absolutely have to be the case, but an overheating economy is a feature of the end of most business cycles, if not all of them, except for the pandemic. Even then, to some degree. But right? I mean, is there recessions you can remember where that an overheating economy wasn't a feature of the end of the expansion going into recession? I think most of them ended in some way or another with an overheating economy.
Maybe
they don't need to overheat.
Oh,
go ahead.
I was just going to say the double dip in the 1980s. The second recession wasn't an overheating economy.
Oh, you don't think so? I mean, that was when Volcker was on the warpath to get inflation down. That's the prototypical kind of overheating.
Yeah, but was the labor market overheating in the early 1980s?
Yeah. I mean, at that point, unemployment, the kind of the full unemployment rate was a lot higher, so it didn't get that low. But yeah, I think that was clearly an economy that was overheated. Maybe it wasn't overheating, but it was definitely overheated. Keep trying to get inflation down. Okay, so
but the economy can grow for a long time without overheating, right? Look at Australia or Japan post-war. You can go for decades.
Well, we never have.
Okay.
Well, 10 years is a long time.
Yeah.
10 years is a long time. But we didn't know that 10-year, the longest expansion in history, I believe, was the one after financial crisis that ended with the pandemic, right?
Right. So it would have, presumably, without the pandemic, could have.
But that's because that expansion was so slow, so painfully slow, that unemployment didn't come in for a long time. We never really got to full employment. I mean, we were debating at the end, maybe we were at full employment, but we just got to 3.5% unemployment, right?
Well, that's because of the catalyst of the recession.
Yeah, absolutely. I agree with you. But that at the end of the day, that also, we were at the end of that lengthy expansion, and I we were arguing. At least I was arguing. The expansion was coming closer to its end than much closer to its end than its beginning, right? Because of the fact that we've gotten very close to full employment. Okay.
But does an economy need to overheat? Is my
I see
point, right? Yeah.
I think, but maybe it's not a necessary condition,
right?
But it's a feature of
many. Okay,
most recessions.
Yeah,
I would say.
Yeah.
Okay. Here's the third set of reasons for recession. So the first is imbalances. Second is overheating. Third is, and you alluded to this as well, is a shock. Something, that shock in the sense that hard to predict. You can't predict a pandemic, can't predict the Russian invasion of Ukraine, right?
Correct.
In most other recessions, I think there's some event that is that catalyst that undermines sentiment and confidence. The sociological reasons for recession, as you called it, Cris.
Right.
It drives people into the bunker. Does that make sense?
Yeah, that's right. So supply shock, it could be a natural disaster, pandemic, as you mentioned. So something like that could be a trade shock, right? Some partner all of a sudden decides they don't want to trade with you anymore.
Or a policy mistake, right? That's kind of a shock, right? You make them, like the Great Depression was in part, or at least the kind of thinking is, debate about it, was an error around trade policy, right? Protectionist trade policies. The economy was obviously already struggling, but that, pushed it under.
Right.
I would also argue that like the financial crisis, the Great Recession, and this may be, one, a policy error, maybe the difference between a kind of a typical recession and a really bad one or a depression. If you go back to the financial crisis, I think I would argue that it went from being what would have been, kind of a tough recession, not maybe worse than typical, but not catastrophic, to something that was catastrophic because of a policy error. And the policy error is that the lawmakers at the time, at the Fed, at the Treasury, and the Bush administration, were dealing with financial institutions that were teetering, and they resolved each of those teetering financial institutions differently. They treated the creditors in those institutions differently, the debtors and the equity holders. And, first was Bear Stearns, and then, Fannie Mae and Freddie Mac, and then Lehman Brothers, and then, there was a million other failures at the time, each treated differently. And as creditors in these institutions realized that there was no cookbook for actually how to resolve these institutions, and they didn't know who was going to suffer and in what order they were going to suffer, the debtors or the equity holders, they bailed. And that's when the financial system cratered. So it was a mistake by policymakers. And again, I don't blame anybody, because this was, how can you, this is crisis mode, right? And you're trying to resolve a problem while you're in the middle of a crisis, and very difficult to do. But there was no cookbook for resolving it. That was a policy error that led to the financial crisis, the very severe downturn that we suffered.
Yeah, that brings up the whole question, the ongoing debate of what policymakers should do, if anything, during recession. Should we just allow the cycle to heal itself, or should we intervene? How much should we intervene? Right, that's where the fun comes in, right?
Yeah.
And what about the moral hazard?
Chris is turning into an Austrian economist on us.
No, not at all. I'm just bringing up the points of debate, right? I think they're fair points on both sides, right?
Yeah, I remember during the Great Recession, there was a lot of concern about moral hazard because of the way the Fed was treating, each bank, and then AIG. I think that, remember when the news came out about AIG?
Well, that's the other one. Yeah.
That's when things really went south.
Yeah. But is it the inconsistency of the policy versus,
or maybe they just didn't understand
if they had chosen not to bail them out at all, right? Send a clear signal, you guys are on your own.
Well, if they did that with, Bear Stearns right away, or with Lehman right away,
would we have been better off than
exactly
mixed? Who knows?
That's a good question. You're right. I don't know. And of course, if you're in that position, if you're Secretary Paulson or Fed Chair Ben Bernanke, and you're left with that, what do I do? It's pretty hard to say, okay, see you later, guys. We'll catch you on the other side. That's pretty tough to do. Of course, they then did that with Lehman, and that, set off a cavalcade of selling. Yeah, okay, so let's bring this back to the current context. So we've identified, broadly speaking, 3 reasons for recession. 1, imbalance; 2, overheating; 3, shocks, right?
Yeah.
So in the current context, it feels like imbalance is not, it's hard to maybe, but not really. Overheating, would you say?
Getting close.
But not, hard to argue that, right? Because 3.6% unemployment is not full employment. We've come to that conclusion. Yeah, but obviously inflation is high, but I would argue the reason for the current recession threat is shocks.
Yeah.
Mm-hmm.
Right? Supply side shocks. The pandemic and the Russian invasion of Ukraine and the higher oil prices. Right? Mm-hmm. Okay. So that's why I think we can navigate through without recession.
Assuming nothing else goes wrong, though.
Well, so yes, that's our assumption, though. Right. That's our baseline assumption. The baseline assumption is that the pandemic continues to fade, meaning with new waves, each wave is less disruptive than the previous one, and that the worst of the economic fallout from the Russian invasion is behind us. Mm-hmm. If you believe that, and you just bought into the logic I articulate around the causes of why recession risks are so high, that would argue for, well, we should make our way through. I mean, obviously a lot of risk around that, but we should make our way through. So how do you respond to that? Right?
I think it's reasonable. I think I'm really concerned about oil prices. And
okay, so you're saying you think oil prices are going higher is what you're saying. Mm-hmm. Okay, so you're saying my underlying assumption around the Russian invasion is not in your baseline. That is not your baseline assumption.
Nope.
Your baseline assumption is what's going to happen here.
The oil prices, they're not going to jump. They're going to steadily increase. Because I think the European Union, Europe's going to put more sanctions on Russia. So if they go full oil ban on Russia, then we're going to get another jump in oil prices.
Okay, that's fair. Reasonable. You just don't buy into the baseline assumption around oil.
Yeah. Yeah. Okay. There's a lot of uncertainty. Forecasting oil.
That's fine. That's fine.
I'm also more pessimistic about the Fed pulling this off.
That the Fed misjudges here.
Mm-hmm.
Policy error.
Correct.
Back to the forms of shock. Okay.
Yeah, so I mean, it's just not one catalyst for recession. It can be multiple catalysts. You can have a supply side shock, a policy error. So it could be like a perfect storm.
Here's a factoid for you. I think every recession since World War II has been preceded by a spike in oil prices. I'm very confident in that statement.
I believe
even
you're
the
right.
financial crisis. The all-time high in oil prices was
8.
July of 2008.
Yep.
Right?
Mm-hmm.
Every single one.
Pandemic?
Yeah. Actually, I should put that on my list of leading indicators. Yeah, okay. Okay, very good. Cris, how do you respond to the way I articulated things and your view that we are likely going to experience a recession?
Yeah, I think we're vulnerable to shock, right? So whether it's an oil shock, I'm still concerned about a supply shock or supply chain shocks, right? Especially with what's going on in China. So I don't think we're out of the woods by any means, and we're in a position now where even if we have a relatively minor shock, we don't have a whole lot of ammunition to fight it, right? So whereas if we were in a normal growing economy, you have a little supply shock, okay, you can brush it off. At this point, might not be so easy, right? The Fed has got bigger fish to fry when it comes to inflation. So.
Okay, so you're arguing that the economy's obviously vulnerable. You know, we're dealing with some pretty massive supply side shocks.
Yeah,
inflation's an issue. Interest rates are now on the rise. So here we are, you know, belly up and flailing. And if anything else comes along, you don't know exactly what that is, but odds are that something will come along and push us underwater. That's kind of what you're arguing.
That's what I'm arguing.
Okay.
Pandemic, all right. Cases are back up, right?
Yeah, interesting. And you're saying the probability of getting something else hitting us that's of sufficient magnitude to push us under is better than even odds.
Yes.
Okay.
A policy error would be at the top of my list, right?
Yeah.
And I think that's fairly likely given the task.
And financial markets are becoming more vulnerable. So just look at the rise in interest rates in Europe. You know, if there's no news of another sovereign debt issue, then it's game over.
For Europe.
For us, because that will feed back through into U.S. financial market conditions. So it doesn't have to be like something that shocks us. It could be, you know, a shock somewhere else that feeds back into our financial markets.
Okay, I want to, there's a lot to just unpack here, but I want to keep moving forward and talk about the leading indicators of recession. But before I go there, I just want to stop, turn it back to you and say, I kind of led the discussion here around the framing, right? Here are the causes of recession, broadly imbalances, overheating, and shocks. And I kind of push things into those buckets. Are you okay with that? Did I miss another bucket of things that you think are important in terms of causing economic recessions that I missed that we should include? I can't think of it. I'm just asking. Am I missing something?
Should we have a bucket for just policy? Because there's fiscal policy as well.
I put that into the shock category, but okay, that's fair. You could do that. Cris,
I think those are the right broad categories of the underlying fundamentals, but I would stress the sociological or psychological, right? The specific timing, why we go into recession in this month versus the month before, the month after.
Yeah,
right? That's a sociological phenomenon, right? So people lose confidence collectively, and that tips us over.
Yeah, I agree with that. I mean, I think the way I say it, a recession is a loss of faith. Faith by consumers that they're going to hold on to their job, faith by employers that they're going to have someone that's going to buy what it is that they produce. If we collectively lose our faith and we run for that proverbial bunker, consumers stop spending, businesses stop hiring and start laying off. You get into that self-reinforcing negative cycle. That's a recession. It's ultimately a loss of faith.
That's right.
Yeah.
And so conversely, you can have some of these shocks without recession, right?
Yeah.
Right. If people don't lose faith, we can actually work through them without actually going. And that's what makes the whole practice of forecasting difficult, right? You have different responses depending on how people are feeling to a large degree.
Yeah. Okay. Let's move on to the leading indicators of recession. What should people be looking out for to gauge whether we're going to go into a recession or not. So there's a long potential list. So Cris, I'll turn to you first. What is your most favorite leading recession indicator?
Oh, it's obvious, right? It's everyone's favorite. It's the yield curve. You have to watch
not Ryan's.
I hate that thing.
See, I told you. Okay, so let's explain it. So what is the yield curve? How do you measure it? Why is it a good leading indicator? What is it saying now?
So it's the difference between the interest rates on long-dated Treasury securities and short-dated Treasury securities, right? Typically, it's upward sloping, right? Typically, if you're going to loan the government some money for a longer period of time, you're going to demand a higher interest rate, right? So that's a well-functioning economy. But in a time of stress or concerns about recession, right, that relationship can invert, right? I'm willing to lend the money to the government for a longer period of time at a lower rate, just to preserve my capital, because I'm concerned that the economy is going to go down and other asset classes are going to be impacted. So what I like about the yield curve is that it is an investor-driven, market-driven measure of the implied probability of recession.
Right. And what's it saying now?
Right now, it's I don't know what I haven't seen recently. It's positively sloping.
Are you? And you? I missed it. Did you say what's your measure of the yield curve you like most? Is it the
10-year versus the 2-year?
2-year. Okay. Yeah. And then why 10 versus 2?
Just historically, empirically, it's been a very prescient predictor of recessions in the past.
And the 2-year is a very good reflection of what investors think the Fed's going to be doing.
Yeah. Correct. That's right.
So if they're going to be stepping on the brakes really hard, that pushes up the 2-year yield. And the 10-year yield is what investors think is going to happen in the long run. So if they think the Fed's going to be successful in slowing growth, then the 10-year yield is going to be lower. And if you get inversion, 2-year above 10-year, historically, that's led to recession. I mean,
that's right.
Led to implies causality. You're not suggesting that. You're saying
it's been correlated
to, because investors are forward looking, and the 2-year represents their collective wisdom around what's going to happen.
Correct.
Yeah. Okay. So Ryan, why that seems so compelling to me? And theoretically and empirically, it's worked. Why don't you like it?
I'm not saying historically it's been bad. I'm saying the last two cycles, or the last cycle since the Great Recession, I think the yield curve is misleading, because the 10-year Treasury yield is no longer a true risk-free rate, because the Federal Reserve is, it can control both ends of the yield curve: short-term interest rates through the Fed funds rate, and long-term interest rates through quantitative easing or quantitative tightening. So it's just not the same yield curve as it was, pre-financial crisis.
Okay, I have two questions for you. One, I thought the Fed was buying securities all along the curve, so they weren't just buying out at the end. So if there's, they've lowered the rate, the term structure of interest rates, but it seems like it's lowered it across the yield curve. So therefore, it should not be affecting the difference between the 10-year and the 2-year.
It's not just, it's a shift. Is it a shift or a pivot, I guess?
Well, it's a shift down.
Shift lower.
That's what I thought.
Yeah, it's not affecting the difference between the two.
The composition, though, I think they were heavier long-term. I think they bought more long-term securities than they did short-term.
Okay.
I'll have to double check.
Yeah. Well, here's the other thing. If you buy into that argument, and there had been and let's just say you're right that they were buying more on the long end than on the short end. You're saying that right now the curve looks more flat or inverted, but isn't that counter to what you're saying? You believe in recession, so you're saying it's not even if there was not that bias because of the Fed's actions on QE, the curve would be even more positively sloped, right? I mean, signaling less likelihood of a recession.
I don't think you need the yield curve to invert to have a recession.
Okay. But that's never happened, right? Except for the pandemic.
There's been false signals from the yield curve, particularly the 10-2.
Not for 50 years, not on a monthly basis. This I know because I just, over the weekend, I spent a fair amount of time on this question. Now, on a monthly basis, now curve convert for, a couple, 3 days.
Yeah.
I don't think that's a strong enough signal. In fact, it did that earlier I think in April. It did that early April. And I don't think that means much, but if it's monthly, I think that's consistent. Investors are saying something consistently. And prior to the pandemic, the 10-2-year got very close to inverting on a monthly basis, but never did. But we did experience a recession, right? But that was the pandemic recession, which is inherently unpredictable. So I don't view that as a blemish on the forecast accuracy. But every other recession since since in the last 50 years, admittedly, there's not a lot of them, but, I think there's 6. Each one of them we've seen an inversion. Still, I haven't convinced you.
I haven't convinced me.
All right. Okay. Fair enough. Okay. All right. What's your favorite recession indicator, leading indicator?
I like lending standards on C&I loans. So, because that's an indication that when banks start to tighten the screws on lending, that, the availability of credit is going to start to slow down. And I think that's, that feeds that lending standards feeds into our probability of recession models. And it does a pretty good job of explaining, foreshadowing recessions.
Does that lead recessions?
Mm-hmm.
Oh, I should take a look. I've never looked at that.
The Senior Loan Officer Survey has the net percent of banks that are tightening on C&I loans.
And that shows a significant tightening in underwriting on commercial industrial loans prior to recessions beginning.
Correct.
Oh, I didn't know that.
And then you can also look at the weekly H8 data. I believe it's the
C&I loans.
Yeah, the C&I lending.
Yeah, but that, the interesting thing about that is when you're coming into recession, it surges, right?
Yes.
It surges because businesses have lines of credit that they draw down when recessions are hitting because they want the liquidity or are fearful of not having enough liquidity.
Right.
So you initially see this pop in C&I loans outstanding that ultimately comes back in. But, so you're saying that the indicator is a pop in C&I loans outstanding. Yeah.
Yep.
That doesn't lead though. I think that kind of lags.
I don't think
it's kind of like a contemporaneous or a bit of a lag. I think it's one of those things that it's good to know because, once that happens, for sure you're in recession. And obviously you're debating it. Okay, I got mine. You ready? And this goes to Chris's sociological reasons for recession. A more than 20-point decline in the Conference Board's survey of consumer confidence over a 3-month period. So it's not the level of sentiment that matters. And by the way, the Conference Board survey, which is more based on labor market conditions, that's pretty high. It's higher than its average over history. It's on the high side, but it's down from where it was, but it's on the high side. But anyway, it's about the change in. And when you see these big, consistent move downs in sentiment, consumer confidence as measured with the Conference Board survey over a 3-month period, that's the loss of faith. That's people running for the bunker and ending their spending. And that happens 2, 3, 4 months before recession. Doesn't give you a long lead, but
did you compare a Conference Board to University of Michigan?
I did. Yeah,
Conference Board does better.
Much better. Much better than the University of Michigan. And right now, the University of Michigan is very weak, right? So
it's down 40 points from its recent peak.
Yeah, and we were discussing, and by the way, it's in a 3-month period, right? Because it's got to be a sharp, quick decline. That's people. That means they're panic mode and they're stopping their spending. Okay. All right. Very good.
Speaking of the Conference Board, what do you think of the leading economic indicators?
That
has a pretty good track record as well, doesn't it?
Yeah,
tends to turn negative.
Has it really been helpful in pegging recessions? I don't think so. Has it?
I haven't done a deep dive, but it's always been
I think I tried it in our probability recession models, but it didn't add much.
Although having said that, I haven't looked at it recently because I kind of gave up on it as a good. It's a good leading indicator of future growth, but not of recessions, not of turning points in the economy, as I recall. But we should take a look at that
because it includes some pretty lagging indicators. I think it includes housing permits and things like that. So,
yeah. Well, of course, the other really good indicator, which is not much of a leading indicator, it's a very good coincident indicator, which is still pretty valuable because when you're in recession, you're we're often still debating it, is the change in the unemployment rate. So if the unemployment rate increases by more than 0.4 of a percentage point in a 3-month period, you are already in recession.
Mm-hmm.
And I think the kind of the chronology is consumers pack it in, 2, 3, 4 months before the recession. It takes a few months before businesses say, oh my gosh, I can't sell, I'm not selling what I thought I was going to sell, and pivot from, hiring people to actually laying off people. And once they start laying off, then we're in recession, then we're done. And that, because that layoffs means higher unemployment. And once unemployment starts to move higher, that's when you get into that kind of self-reinforcing negative cycle, because unemployment starts to rise and then consumers say, oh my gosh,
right.
Now I'm losing my job. My wages are getting cut. I'm getting no bonus. They pull back further. Businesses see that. They fire more people and you're off, into the abyss. And that's a recession. Yeah. Okay.
What could be interesting in this cycle is that the unemployment rate could be rising, but for the right reason, that more people are being pulled into the labor force.
That's a good point.
So, but I mean, I still think there's that psychological, because people, are going to watch the news and see the unemployment rate go up and start panicking, but it could be rising for a good reason.
Yeah. Right. So it may not be the same, may not be as useful this go around, is what you're saying.
It still would be useful, because I still think the average person will panic when they see, the news, CNBC, Bloomberg talking about higher unemployment rate.
You guys did not mention
jobs
the stock
are still
market.
plentiful. You don't think?
Oh, sorry, Chris. Go ahead.
If jobs are still plentiful, you don't think that that's the stronger factor here? Yeah, unemployment rate's going up, but I still see plenty of opportunity. You don't?
Mm-hmm. That could be. I mean, we have 11 million open job positions, so
yeah.
And by the way, that's another reason why I'm more sanguine about making it through without recession. Just feels like, the job market is so rip-roaring, so many open, unfilled positions, quit rates are so high. It's going to be pretty hard to kind of have that thing kind of come to a standstill and go in reverse, it feels like to me. But anyway, you guys didn't mention the stock market. You don't think that's a good leading indicator?
Half the time it is.
Yeah. Probably better than the yield curve.
Yeah. That's all the old Paul Samuelson quip, the Nobel laureate, who said the stock market has predicted 9 of the last 5 recessions.
Yep.
So it can definitely go down, no recession. But although I think every recession has featured a big decline in stock prices. I'm not sure if it's much of a lead, but we've seen big declines in stock prices.
Mm-hmm.
Okay.
What about, on that note, what about credit spreads?
Yeah, I was going to ask Ryan. I haven't looked at credit spreads being the difference between rates on corporate bonds and treasury yields, risk-free rate. That spread would reflect the concern investors have over the potential that those companies are going to default on their debt. So it should be a good indicator. Ryan, is that a reasonably good leading indicator or not?
It's okay. I mean, I think you have to include all these things together. You can't just hang your hat on one of them. I mean, I did try using corporate credit spreads in our probability recession model, and the yield curve was it pains me to say, but the yield curve worked better than corporate bond spreads.
Oh, really?
In predicting recessions, yep.
Say that again.
In predicting recessions.
No.
What? I know. You're trying to bait me.
The connection's breaking up. Could you?
No, oh, where's the storm? By the way, I'm looking outside and it's like perfect sunshine out there.
I know.
Yeah. They send the kids home from school. Jeez Louise. We never got to the game. Let's do the game real fast and then talk about recession probabilities in the current context, and then we'll call it a podcast. I've kind of given you my statistics. I can give you another one. But Ryan, what's your statistic?
All right, I got 2 of them. They're related. All right, so it's minus 3.7% and minus 2.1%.
Is that the average decline in GDP and jobs, peak to trough in recessions since World War II?
No, you got it. It's the average decline, peak to trough in GDP for the last 5 recessions. That's minus 3.7%. But if you take the pandemic out, the average decline's 2.1%.
Okay, but you got to be impressed with.
I'm really impressed.
Yep. Laser-like response.
Yeah.
All right.
That was impressive.
And I bet you if you go look at the decline in jobs.
Oh, yeah, it's probably right. Yeah.
Yeah, just say it. Just say it. All right. And you probably picked 5 recessions because you didn't have enough time to do all of them back to World War II.
And I didn't have time to do all of them.
That's right. Very good. That's very rough. So you're saying the typical peak to trough decline in the past 5 recessions in GDP is 3.7%, including the pandemic.
And the Great Recession, yes.
In the Great Recession.
So if you take out the pandemic, it's 2.1%.
Because in the pandemic, it was down like 10.
10. Mm-hmm.
Yeah, 10 on the nose.
It's massive.
And I think the Great Recession was 4 peak to trough.
It was.
It was. Yeah. Okay. All right. Very good. Cris, what's your statistic?
I can give you a fun one or a mind-blowing one.
Let's do both. Fun one first.
The fun one. How many global recessions has Ryan experienced in his lifetime?
Oh, I love this.
Oh, this is a good one.
Yeah. So Ryan is about 18.
Yeah.
No. Ryan, you must be 40. Are you 40 years old?
42.
42.
So I was born in 1980.
And you look like you're 32, by the way.
Oh, I appreciate
42. You could still
for sure.
So 42 would put us back to what, 1980, right?
1980. Mm-hmm.
And the U.S. has experienced, I think we've experienced 5 recessions since then. Something like that. And you're saying global. Is this every country on the planet? Developed, undeveloped?
Global recession, right? So IMF goes through and says,
right? They not say, how many. You see what I was doing? I was going to tell you.
Yeah.
No, okay. So how many?
How many times has the world economy gone into recession?
3?
I'd say 5 times.
5 times? No, that's actually how many times. Well, I don't know.
That's how many times the U.S. has gone in.
3?
I think that's how many times you've experienced a global recession in your lifetime.
Well, no, 1980, 1982, 1990, 2001, 2000.
1980, global recession. Right?
Yeah, global. That wasn't global.
1980 was not a global recession?
No, 80. You want that? There was 4. 82, 91, 2009, 2020.
Well, hold it. Didn't I say 5?
Yeah, you're off.
Yeah.
I'm off by. I'm off by. Oh gosh.
Precision.
How many are there?
Precision.
Okay. All right. Okay. You
and I experienced 75 too. Right.
That's true. Was there a global recession in 82?
Yes.
Okay. They're the U.S. That was really one recession. It wasn't 2. U.S. did 2. The rest of the world said, no, we're not following your lead. We're going to call this 1.
All right, you're gonna have to go back to the committee.
I'm just saying.
File an appeal.
Okay. All right. We've had a long conversation here, and I should have had us articulate what we think the probabilities of recession were before we even had the conversation. But we have run a survey off of Twitter and at Mark Zandy. By the way,
that is.
What's yours, Ryan?
At realtime_econ.
Yeah, there you go. Off Twitter and LinkedIn. And I think I'm looking right now, we had 155 responses. And the question was, who do you think is closer, Mark, Ryan, or Cris, to the probability of recession between now and the end of 2023? Let's say 18 months from now. So over the next 18 months. I said 40% probability.
Mm-hmm.
Cris said
55.
55, yeah. And Ryan, you said 75.
Correct.
Okay, so the survey responses are Mark, me, 45% of folks buy into what I'm saying. It's a 40% probability of recession through the end of 2023. 38% buy into Ryan's dark pessimism, 75% probability through the end of 2023. And 17% buy into Chris's down the middle of the road. So it's kind of a barbell distribution.
Mm-hmm.
Either you're really pessimistic or you're reasonably sanguine. You're not in the middle. It's interesting. Okay, let's end it this way. I'm at 40% probability. Before we had this conversation, Cris, you were at 55. Ryan, you were at 75. What is your probability of recession now after this conversation?
Go ahead, Cris.
Cris goes first.
Because he's going to go to in the middle.
I haven't changed. Maybe I've bumped it up actually, a little closer to 60.
Really?
Ooh, coming to the dark side.
That's still pretty good odds.
But that's not enough to change the baseline forecast.
That's correct.
Oh, that's so smart. For folks listening, we have this rule that if you want to make a big change in the forecast or underlying assumptions, you have to be very confident, meaning subjectively, there has to be a 2/3 probability that that's going to happen before you make the change. And you're not quite there yet, but you're getting close. You're getting close. Okay, Ryan, you're at 75. He's stubborn, Cris. He's not going to change.
No, I was going to bump it down to probably 65 now.
Oh, really?
That's a big
jump. Convinced me.
That is huge. That's a huge. Okay, so what changed your mind?
Going back to like the imbalances and everything.
Yeah.
I think the economy can withstand. It's got to be a pretty big shock, I think.
Yeah.
Which I'm not confident the Fed's going to do it, pull it off, but we'll see.
Yeah. Okay. Well, I'm still at 40, but I'll have to tell you, I sat down this weekend and wrote a piece, and it's up on EV on recession indicators, and really kind of went through things. I actually felt better after doing that about the economy's prospects. So I still think it's uncomfortably high at 40, but I'd say the risks to that are to a lower probability.
How many cherry sodas did you drink when you were writing that piece?
Well, again, no alcohol.
Okay, just checking.
No alcohol. Anyway, okay, that was a great conversation. I know there's so much more we could have talked about, policy and monetary and fiscal policy and, severity of recessions, but maybe we'll come back to that at a future podcast. But I think we should call this one a podcast. What do you guys think? Anything else you want to say or cover at this point?
Wait, Cris, what was your mind-blowing number?
Oh, he didn't tell us his mind-blowing number.
You want the mind-blowing numbers very quickly. Here's the question to you. What fraction of the time was the U.S. economy in recession from 1857 to 1900?
Oh, my.
Wait a second. This is, you can see I'm looking out here, so I'm not looking at anything. The typical recession on average was 17 months. The average length of the business cycle was about 60 months. So what is 17 divided by 60? That's the number. Is that right?
No.
What? Hold on, wait.
1857 to 1900. So just
1900.
Yeah,
I was thinking. Well, I said 1854 to 2020.
Let me give you some context. Since
okay, no, it's okay. Wait.
Oh, okay.
40% of the time we were in recession before 1900, and since World War II, it's down to 15%.
Oh, so close. 50%.
50. I was 50 before 1900.
From 1857 to 1900, and then 14% from 1955.
This is, this is, people listening to this now understand why I'm chief economist. Just saying. Right?
That's pretty impressive. What about since 2000?
Since 2000?
Yeah. How long have we been?
I could probably do that. I can actually calculate that. So in 2000, that recession was probably, I don't know, maybe no more than 9 months. The 2008, that was 18 months. The pandemic was 2 months. Mm-hmm. So 2, 11, 18, 29. I'd say kind of 29 months out of 100 so it's 3 decades, 2000, 2010, 2000, to be
22 years,
240, 10% of the time.
Oh, 11. Very good.
There you go. See how I did that? All right, baby. Oh yeah. It's so fun to be an economist. I don't understand these jokes. Accountants, economists, weathermen, economists. I love my job. You guys love your job?
Oh, yeah.
Absolutely.
Unbelievable. Yeah. What a job. All righty. Okay, we're going to call this a podcast because I think we have another one after this. So we should go. I'm going to get more cherry drink and we'll reconvene. All righty, guys. Thank you.
Thanks.
Take care.